Hello and welcome to ETF Pulse, ETF.com's vodcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com. Here as always with Nate Geraci, Nostradamus, president of the ETF store, and as always, my co-host. Let's take a quick look at the Pulse rundown. So first up, we're going to be talking about the Oracle of Omaha. He retired over the past weekend and what his recommendations are for investors for years to come. Then we'll be taking a quick look at some inflows over the past week. You might be surprised what raked in billions. And stocks are essentially back to even after quote unquote Liberation Day. That is the day that President Trump announced that the tariffs would be going into effect. And Vanguard celebrated its 50th anniversary just a few days ago. We'll be talking about what Vanguard has meant to investors, particularly as VOO is now the world's largest ETF. And last, we'll be wrapping up with Defiance's newest ETF. It's a first of its kind leveraged income ETF. We'll be talking through what that means and if it's worth adding to your investor portfolio. Hey, Nate, how are you?
I love how this Nostradamus nickname that you came up with, I feel like it's catching on.
I love it, and I'm going to get shirts that say it. So it's funny that I'm calling you Nostradamus ahead of this first segment because we have Nostradamus talking about the Oracle of Omaha, Berkshire Hathaway's Warren Buffett. So we had the, very big shareholder meeting over the weekend, and Warren Buffett actually announced that he would be stepping down in his role at Berkshire Hathaway. I mean, he is 94 years old. I think the man has more than earned his rest at this point and retirement. But there's obviously a lot of reasons that we'd want to talk about Warren Buffett. I mean, one, again, we call him the Oracle of Omaha. He is one of the world's greatest investors. But what I loved when he was talking about stepping down was actually this piece, which I think ties in quite nicely to ETFs, because he's obviously been a very avid ETF investor for years now. So he said that his directives are, once he passes, that his assets are to be 90% invested in index funds. And actually, he said low-cost S&P 500 index funds, Vanguard, we'll be talking them later, so that's VOO, among others. There's others, obviously, and 10% in short-term duration bonds. That's it. That's his 100%. I mean, what an easy formula for, I think, everyone to kind of follow. I mean, I don't know if I would say like, forget everything else, guys. Just 90% of your portfolio needs to be in index funds. But I love how simple his whole investment sort of strategy and also ethos is.
First of all, isn't it funny that everybody was shocked that a 94-year-old is stepping down?
No.
It just shows the staying power of him, right? Year after year, he's been here. And he's just been such a staple in investing and in the markets. I just thought that was funny with these headlines, shocking departure of Warren Buffett.
No one would say that about anyone else. 94-year-old steps down. It's always 94-year-old would go back to work. I think people are just going to miss his commentary on, especially as we see a bunch of new assets kind of come to market. He pretty much called Bitcoin trash, essentially. So you and him disagree there.
I think it was rat poison.
Yeah, he called it crap. But he's always just been so, he has so many great investment isms, I'm going to call them, like really great nuggets that I think anyone can kind of follow, whether you are a retail investor or you are a financial advisor, for you to kind of follow as part of these tent poles or guiding posts in your sort of investment journey.
Well, a couple of things there. First, going back to your comments around, him putting 90% of his money into an S&P 500 index fund, and then 10% into short term.
Yeah, low cost. Low cost.
I find this interesting because Buffett has been this master stock picker, yet he's basically telling everybody not to try to do that, right? Which I like his message. I just think it's kind of ironic that he's basically saying that he can outperform the market, but you shouldn't try to do that. Now that said, he's probably right?
I mean,
in that.
I think he also is very clear that he's like, listen, broad strokes, you can't beat the market, so don't bother trying. That's always been his message. Why waste your time or your energy trying to figure out what will beat the market when you could just invest in the market, and that's good enough.
Yeah, and I think Warren Buffett knows better than anyone how hard it is to pick winning stocks. And I think more importantly, just to have the temperament to stick with him through thick and thin. And so I just think he believes for most people an S&P 500 index fund, it's a better way to go. And obviously, he's a huge believer in America, right? He's always championed this
Yeah.
country. He always talks about that. So from his perspective, why not just own 500 of the best companies this country has to offer? Again, I think it's funny because he is this master stock picker, but he's telling people to invest in index funds. By the way, did you see the table or the chart of his returns that came out Saturday that showed his performance from 1964 through last year? Okay, listen to this. He has returned nearly 20% on an annual basis versus 10.4% for the S&P 500. So if you do the math on that, and he had this math in the table, that works out to a return of like 5.5 million% for him or Berkshire compared to 39,000% for the S&P 500. So my point is he has the receipts for himself being able to outperform the market. He just doesn't think other people should try to do that.
And they probably shouldn't, because can I give 20% returns consistently over the course of, 70 years? Probably not. I mean, sometimes I do, and I feel like I'm a genius, but I mean, for most
You're
people,
not doing 5.5 million% over whatever time period. I'll bet anything on that.
Right. So that's 5.5 million, but you then also said versus 39,000. And
Right, on the
39,000
S&P.
great. That's great. For like,
Yeah, that would have beat almost all comers, that 39,000% over that time period.
I know, like I wouldn't be unhappy with a 39,000% return, especially having done no work for it, right? He's had to work for it. I mean, the man is in his 90s. That's the kind of time and sort of sweat equity that he's had to put in to become this person. And I don't want to do that at all.
The other thing that I love about Warren Buffett, think about even just over the past 10 or 15 years, how many times people have said, oh, we have the next Warren Buffett coming along, right? There's this next hot manager. And so, an easy one to point to would be somebody like ARK's Cathie Wood, right? I remember back when she was on that run in 2020, 2021, there were a lot of headlines that she's the next Warren Buffett. And if you looked at that point since ARKK's inception, the ARK Innovation ETF's inception, it actually was outperforming Berkshire. I'll never forget, I tweeted out a chart of that showing that Cathie Wood was outperforming Warren Buffett. I got a bunch of nasty comments back. But my point is Warren Buffett's been, Warren's been like the tortoise, right? And the tortoise and the hare. He just keeps marching along, and you have these hot managers come and go. And then you look over the long-term time frame, and these other managers aren't even close. Like Berkshire has blown ARKK away performance-wise.
I mean, I just decided to pull it up as you were talking about it. I mean, ARKK, and we're going to talk about the S&P 500 generally. It's down almost 11% just year to date. And over the past 5 years, it's down over 1%. It's just in the negative. I mean, it's ARKK might be the next widowmaker after TLT, which you described as the first widowmaker. But and Cathie Woods is she's so lovely and so sweet. And I think that she has a really a ton of the way that she's thinking about the future. But no, her performance does not stand up to Warren Buffett.
Yeah, my point, and to be clear with Cathie Wood and ARK, I mean, they've stuck with what they said they're going to do, right? They invest in disruptive tech, just hasn't been a great place to be recently. My point is just that over the years, I'm sure Warren's heard of all these other, managers or investors.
Top spot, and they haven't yet.
Hasn't happened.
And they won't, because he's going out still on top in I don't want to say blaze of glory, but I mean, he's going out on top. I don't know who will come to replace him. I'll be curious to know if he kind of still does some market commentary here and there, like how often people will be able to reach him for some sort of interviews.
Hopefully he doesn't come back. Remember, Michael Jordan should have gone out on top, beating the Jazz, and then, bounced around, comes back playing for the Wizards and stuff. I don't think we'll see Warren Buffett coming back.
Yeah, no, we don't need, and no. It never works out. Tom Brady tried it. When you say you're going to retire, you need to just retire. Don't try to.
Brady did win a Super Bowl, so it did kind of work for him. But I hear what you're saying. In general, it doesn't work. I don't think Warren's going to have that kind of luck.
Process, but that's neither here nor there.
But fair.
All right, so let's talk really quick inflows, because I found it was so interesting that as Buffett was talking about invest in low cost S&P 500 index funds, but also this 10% into, and he didn't just say all fixed income, he specified short-term duration Treasury Bond ETFs. And they actually led inflows last week, specifically SGOV, which as a reminder for everyone, is the iShares 0 to 3 month Treasury Bond ETF. Sometimes these ticker names just escape out of my head. So SGOV pulled in $1.1 billion last week. It was followed by just Bill, which is the Spider Bloomberg 1 to 3 month T-bill ETF. That pulled in over 400 million. And then all told, I mean, more than $3.5 billion were brought in just by fixed income products last week, as investors are really kind of piling into the trade. And then, of course, this week have the FOMC meeting. So Fed rates are pretty much believed to just be staying steady right now, but that's where it's at. I know we've talked about this before. Obviously, investors are just very much nervous about the economy, about recession fears, and so they are piling all that cash, not into TLT, but they are doing it into those short-term duration bond ETFs.
Well, I'll give you two other stats, and we did talk about this several weeks ago, but if you look at SGOV, it is now number 2 in ETF inflows overall for the year, with over $16 billion. So, there's 4,200 ETFs, which, by the way, you'll be forgiven if you forget a ticker or a name of an ETF with 4,200 of them out in the market. But think about that. 4,200 ETFs, SGOV is now number 2. And then BIL, which you mentioned, that's number 5 overall for the year with 11 billion.
And they're all
So,
invested by VU. So
yeah, and it's the same thing we talked about before. I just think with the uncertainty in the market, there's worse things you can do than just parking in short-term treasuries or even short-term corporates, scooping up your, 4+% yield and just waiting for the clouds to clear. I just think there's a lot of investors that are taking that approach. And if we even put the equity markets aside and just talk fixed income markets, there is uncertainty there. There's uncertainty over what credit's going to look like, potential credit risk moving forward if the economy slows. We don't know exactly what's going to happen with the direction of interest rates. You mentioned the Fed meeting. They're in a tough spot right now because the tariffs are inflationary, and inflation has remained elevated even though it's come back down. So are they going to increase rates? They got to be mindful of the employment picture. So there's a lot going on there. And I think all of that uncertainty is why investors are looking at these short-term treasuries. I'll give you one more, by the way, which is interesting. So I know we're going to talk Vanguard later on, but I'll set the table a little bit for us. They launched a 0 to 3 month Treasury bill ETF in February. So the ticker is VBIL, VBIL, good ticker. That thing is already over $1 billion in assets. Think about that. I mean, just in a few months. So, but it speaks to everything we're talking about here. It just shows the appetite for these short-term Treasury products.
And we will talk Vanguard in just a couple minutes, but first let's look at the broader market because we've had a 9-day of rallies by the end of last week. We have a bit of a down week so far this week. Again, FOMC meeting and more headline around trade deals, but essentially Trump kind of put tariffs in place April 2nd. So, we're over a month now, March, April. Yeah, we're over a month now since Liberation Day, as it was called back then. We used to have the S&P 500 down 6%. We are now down 3.5% for the year. So we are kind of on a way right back up. And I think, again, this kind of points out the fact that we've sort of snapped back and rallied from those major losses is, again, what you have been telling everyone on this podcast, and I'm sure elsewhere, which is that this trade war, tariffs, US-China stuff, like you can't trade around it. You have no idea what's going to be happening from one day to the next. Stick with your investment strategy. If it's something that is sound and something that you can believe in for the long term, just stick with it. And if you were someone who sold, ouch, I mean, you've really missed out, as what always happens, right? In bear markets overall, you miss out on the gains on the other side. But I mean, things are starting to look up. I say that with my fingers crossed, though, because watch us talking about this now. Next week, we're like, markets have made an about face and have decided to sink twice as badly since Liberation Day. So
that's what I was going to say. Like, do I get to take a victory lap yet, or is it too early?
No. In fact,
no victory lap.
I'm touching wood right now. Honestly, I think it's too soon for victory lap.
I am going to take a little bit of credit on this one because I have called this absolutely perfectly over the past month, right? I said the entire tariff situation was simply uninvestable. And now here we are. The S&P 500 is positive since President Trump's, quote unquote, Liberation Day. And I kept saying, and you already know where I'm heading, Kristin, you have to put politics aside. Yes. And I feel like a lot of investors, they got wrapped up in how Trump was handling this and sort of the messaging, instead of just taking a step back and actually thinking about how this might play out, right? I feel like they let their feelings of Trump get in the way. And now, to be clear, and this is what you were saying, we don't know what's going to happen moving forward, right? Maybe we do end up getting a recession due to these tariffs and stocks slide back down. But so far, a lot of these doomsayers have been completely wrong. And that was my point, right? You simply couldn't make intelligent investment decisions based on whatever was coming out of the White House on a day-to-day basis, and you
Yeah.
still can't
You
around
can't
this.
invest based on what's going on Truth Social. I mean, you just can't. I mean, and we have, at least not with particularly this presidency, right? I think there are some policies that can kind of come out the White House, regardless of who's in office, that an investor probably should pay attention to. But it was very clear, not just from this, but from the first time around that we had a sort of trade war, but particularly what we've seen here was that the movement day to day on the policy was not static. It's one thing one day, it's another the next day. That's not
Yeah,
any
and to be clear, like, I mean,
and create an investment strategy around.
yeah, and to what you were saying, I mean, I do think it's important to pay attention to what's happening, but paying attention to what's happening and then making investment decisions based on that are two different things entirely. And that's where I think it all got melded together, and you fold people's political views into that. And I think that creates a bad mix. We always say don't mix politics with portfolios. And I just think the past month has been a perfect example of that. Now, again, we don't know what's going to happen moving forward. And like I said, we could be sitting here next week talking about how stocks are down 10%, which, by the way, I'm going to bring this back to Warren Buffett. I love this. He said on Saturday, like, if you can't stomach a 15% drop in the markets, maybe you should try a different investment philosophy. You know, his point was, like, if you can't stomach stocks moving up and down 15%, you probably shouldn't be all in stocks. Anyway, I just think that's relevant in the context of what we have seen over the past month with this tariff situation. There's just been a lot of overreaction.
The leveraged traders are not listening to you because they're still leveraged, and inverse ETFs are still raking in so much money every day. I'm looking at, the market mover tool that we have at ETF.com just for, like the top actives or like the top, and it's always, well, of course, I mean, they're some of the most active, so you have to be.
Yeah, I mean, that's a different breed altogether, right? We've talked about this. You have degenerate gamblers as part of that. You have very sophisticated institutional traders and hedge funds using those products. It's a mix.
I mean, listen, volatility loves leveraged. I mean, what could we say? There's a lot of people making a lot of money right now. There's also a lot of people losing a lot of money right now. So again, to bring this back to Buffett, just listen to the Oracle and to Nostradamus. You don't need to try to stock pick. You don't need to try to beat the market. You don't need to try to like scrabble for that 5.5 million% gain when you can do nothing and get your 39,000, because at least it's pretty much only upside. It's very little risk that way.
Can I be the Oracle of ETFs, or is my head getting too big?
No, it's too big. I first of all, I will, that name can only happen once I bestow it upon you, and I haven't yet. We're going to stick with Nostradamus for now.
Nobody likes self-proclaimed names, right? Yeah.
Proclaimed, Miss Cleo of ETFs. Like, that's not going to work. And that's a throwback for anyone that used to watch late night TV. If you're a Gen Z or Gen Alpha or whatever, you have no idea what I'm talking about.
No idea.
All right, so let's talk about Vanguard. May 1st. So that was a couple days ago, about a week ago now. Vanguard celebrated its 50th anniversary. I mean, what a ride Vanguard has really been on over the last 50 years, from becoming, I think, one of the most and one of the biggest asset managers and issuers that investors know of. I mean, you mentioned V-Bill sucking in $1 billion just over the last couple of months, but I mean, VU, right? And whole portfolios are built on the back of that one ETF. It is the world's largest ETF now. I mean, what an incredible journey. We have a new CEO, Ramji. I think the work that Vanguard has done has really been incredible over the last 50 years. I'm excited to see what they decide to kind of do next and where they're kind of going to go head forward in the next 50, especially with so many issuers trying to take a little bit of their lunch.
Well, I asked the question, has any fund company ever done more for investors? Personally, I don't think it's close. I can't think of another asset manager who has been more on the side of investors than Vanguard. And the thing to me about Vanguard,
one area,
it's not just, what's that?
Except in one area, how has Vanguard not been on the side of investors?
Well, we can get to that. I know where you're heading, and I will definitely comment on that. But what I was going to say is, no, I just think it's important to note, when people think of Vanguard, one of the first things that comes to mind is the fees, right? They're low cost. And the thing to me about Vanguard, it's not just, what's that? Well, we can get to that. I know where you're heading, and I will definitely comment on that. But what I was going to say is, no, I just think it's important to note, when people think of Vanguard, one of the first things that comes to mind is the fees, right? They're low cost. We talk about it all the time. And,
Mm.
the other thing I think people immediately think of is just the index-based approach to investing. But I think you have to even go broader than that and just think about the overall investment philosophy, which that obviously came from their founder, Jack Bogle. And this is similar to Warren Buffett. I'll tie it back to what we were talking about earlier, in that Bogle always preached thinking longer term, right? Like you should buy and hold and let the market work for you. And certainly the low fees and taking an index-based approach to investing, those get all the headlines and they're very important. But think about how much money Vanguard has probably saved investors just by preaching that long-term buy and hold philosophy. I just think sometimes that gets lost. But you add it all together. You have the low fees, you have the index-based approach. They have active, but I'm just saying, I think a lot of people think index with Vanguard. And then you add in thinking long-term. I mean, that's been a proven recipe for success. And so I just think it's, again, you add it all up. I don't know that another fund company has done more for investors. Now, to your point, let's talk about the next 50 years.
So,
What you were alluding to is they're
yeah,
not offering a, spot crypto ETFs, right? They
yes,
don't offer them as an issuer, but they won't even let investors access them
on their
on the
platform.
brokerage platform,
Yes,
right?
correct, right, exactly, because they're not just an issuer, they are also a brokerage, and they've completely blocked access to cryptocurrency. Now, like you said, they are on the side of the investor, buy and hold long term. But again, looking at the past 50 obviously makes you think of what's the next 50 and what's the next frontier. And in this area, Vanguard has been totally intransigent when it comes to the issue of cryptocurrency, even as we see other major brokerages and asset managers, your Fidelities, your Schwabs, kind of fold and sort of accept that the future is here. Vanguard has been, I mean, I would say like the lone holdout, honestly, in this area.
And where that's going to cost them, like I'll just think of myself as an example. So I love Vanguard's investment approach, like taking an index-based approach on the equity side and the fixed income side, minimizing your costs, et cetera. That's a great recipe for success. But you know what? I like to dabble in a little crypto as well. And I'm speaking to me, but now I start thinking about younger investors where crypto is just a normal part of their investment experience. I think there's a lot of investors who really appreciate Vanguard's approach on the equity and bond side, but they also want to dabble in crypto. And
Yeah.
I do think there's a point at which Vanguard risks alienating those younger investors
The
because,
next generation of
yeah,
investors.
the next generation. So when you're talking about the next 50 years, that can be problematic for them. Now, again, I've said this before. I'm sure everybody in Vanguard's boardroom, they're just like praying that the price of Bitcoin craters and Ether craters and everything goes up in smoke, and then they'll take a big victory lap. But I think we have enough data points now, and this isn't any prediction on price. I mean, crypto's here to stay. It's not going anywhere. We can argue which ones are going to be successful over the long term and how exactly this looks over the next several decades, but it's not going away. It's here to stay. And so being the second largest asset manager out there, I feel like they need to at least even if they don't embrace it, not prevent people from embracing it, which is what they're doing on their brokerage
Right,
platform.
right. I think that will probably be the first thing to fold. I mean, although it is interesting, sometimes we do see, like in the case of Fidelity, right? What happens on their brokerage side and what happens on their asset manager side seems to be not in lockstep with each other. I wonder which will fold first. If the brokerage says, okay, fine, we'll let you guys access crypto through our platform. And then, as issuers, they actually start creating some of those products. But I don't think in my mind that Vanguard can retain its crown the way that it has over the next 50 if it doesn't choose to evolve, right? I
Well,
mean,
just think about their advisory service they offer, right? So they have a full financial advisory service.
right.
And I just think about, say, a client calling in asking about Bitcoin or Ether or some other crypto. What is the response of that advisor? Like, just nope, we don't believe it. We're immediately,
Yeah.
shutting you down. Like, we're not even going to have a discussion about that. I don't think you can do that as an advisor. I think you at least need to be conversant and be open-minded, really, about any investment out there. You don't have to agree or disagree with it, but you better be able to talk the talk, have a conversation, and be willing to answer client questions around this. But with their current approach to crypto, that's not my take or my impression of how they're handling this. They're just saying, nope, we don't do it. Sorry.
Yeah, no, like, and I mean, you don't even have to look at the world of finance alone, right? This is just evident all throughout history that the folks that are refusing to accept the future when it comes often get left behind. And so I think at some point, Vanguard will have to fold, or they'll be massively proven right. I mean, it's only one of the two, but I think it's going to be more the former than the latter. Or Vanguard's just going to be forced, if they want to continue on the path that they've kind of created and set, they're going to have to accept that cryptocurrency is here. And I just imagine as they're, you know, the folks inside the company also get younger and younger, I imagine those decisions are going to start reflecting what we are seeing the investor appetite to be, and to really.
I agree. Yeah, I think they're gonna fold on this issue at some point. Real quick before we move on, I pulled two stats for you on Vanguard that I thought you would like in celebration of their 50th anniversary. Maybe you already saw these.
I love.
I thought you might like these. So their CEO, as you mentioned, Salim Ramji, he said that they have cut fund fees over 2,000 times over that 50-year period. So if you do the math on that, that works out to like 40 fee cuts a year. I mean, think about that for a minute. 40 fee cuts a year, that's almost hard to believe. So that's stat one for you. And then the other one, and you can react to these if you want. I'm sure you saw this. We've talked about VU.
Yeah.
$21 billion in inflows in April. Bloomberg said that was the 5th biggest monthly inflow for any fund ever. And that was its largest inflow, VU's largest inflow ever, like in history. And I'll tie that into the fee cuts just because, you know, that only costs 3 basis points. And, you know, one of my predictions for 2025 is that maybe VU cuts fees to 2 basis points. If they keep getting, well, if they keep getting inflows like that, the flywheel keeps spinning. And, you know, that's how Vanguard operates, right? The more assets, it helps with their economies of scale, and ultimately they can pass savings on to investors. So I just thought you might appreciate those two stats, and also just to end on a positive note.
And I think investors will appreciate it. But yeah, almost over $56 billion of inflows so far this year.
It's wild.
Absolutely insane. Absolutely insane. All right, let's talk Defiance, because they've launched a new ETF, the Defiance Leverage Long and Income MSTR, so MicroStrategy ETF, ticker MST. It's leveraged exposure to MicroStrategy. And then it's also aiming to generate income through an option strategy. I feel like we're seeing a lot of this now, where like two strategies are kind of getting mashed together into one ETF, either two strategies or even two commodities, right? I'm thinking about, I think it's BTGD, right? Where they mash together Bitcoin and gold into like one ETF. I feel as if this is like the new frontier that we're going to be seeing when it comes to sort of ETFs, where we're like, we've got this strategy and we're layering it with this strategy, but leveraged MicroStrategy. So this is in a way a Bitcoin play in its own way, a proxy Bitcoin.
It is, yeah.
Essentially, right? Because it's MicroStrategy, and then also generating income at the same time. I mean, what are your thoughts on this?
I have a lot of thoughts on this.
I mean, look at you, you're practically radiant.
Well, let's first of all say this is a first of its kind ETF, which is always interesting to me. So as you noted, this is a leverage MicroStrategy ETF that pays income weekly. And before I give my thoughts on this, let me first say, and we've talked about this before, I don't have any sort of issue with these types of ETFs coming to market, as long as the risks are properly disclosed and the ETF does what it says it's supposed to do. So, we talked about this, free markets, capitalists, let investors decide what they want to buy. However, I do wonder, like, who is looking for leveraged exposure at the same time they're seeking income?
I knew you were going to say that. I absolutely knew you were going to say that. Wait, let me read a quote from Sylvia Jablonski. She's CEO of Defiance ETFs, right? And so in the press release, this is what's said, and this ties into exactly what you're saying. Quote, retail investors want the thrill of leverage and the comfort of income. The thrill of leverage and the comfort of income. It's almost like an oxymoron in a way.
100%. I mean, those are in conflict, right?
I actually don't know of anyone who at the same time, it's like saying I want a leveraged buffered ETF. I mean, they just don't work together.
Which they have versions of that, by the way, where you can get like leverage to the upside and there's a buffer. But let me say this, just to be clear, like I get levering up to increase income, but that's something, say, like a closed-end fund or a
Right.
hedge fund might do, right? Levering up bond positions. I just think to do this on a single stock like MicroStrategy is interesting, shall we say.
I mean, like I said, it is a proxy Bitcoin play.
Yeah, I mean, but MicroStrategy is, I think, really a leverage Bitcoin play in and of itself,
Right.
right?
Yes.
So then you have leverage upon
This is
leverage,
leverage upon leverage.
but
Exactly.
let's squeeze out a little bit of income as well.
I think your point is well said, and I think we're going to have this. We've already said this. I mean, listen, we talked about this last week. We've got an average of 70 launches happening every single month. We've got over 4,000 ETFs that already exist on the market. New issuers are coming every day. We're seeing mutual fund conversions. The reality is that if you are an issuer and you're coming out with some new and novel, not that the world of innovation is small and that there's not a lot of places where we could go with ETFs, but I think at some point you have to do something different to kind of keep your head above the fray. And I think we're going to start to see ETFs that we're going to ask the question, at least you and I, which is who wanted this and who needs this in their portfolio. And it's not a knock on MST or the strategy really, but I don't know who was calling for a, as you put it, almost a leveraged upon leveraged micro strategy, and then also the convenience of income at the same time.
Here's the good thing, though, about what you're saying. And, you know, to your point, like Sylvia Jablonski and Define, I think they do a great job. I love the innovation in the space. I really do. And the beautiful thing is when you're saying who wants this, investors will decide. And I know that's a little cliche, but we always talk about how ETFs are a meritocracy
Yeah.
and money's going to flow, you know, to where it's best treated and where investors want it to go. And so the market will dictate which of these, you know, ETFs make it and which don't. What I do think this does for investors is it raises the bar for ETF education. And this is something I've talked a lot about because these products, you know, they are growing more complex. And I think, you know, just modeling out like the path of returns and how this may operate in different market environments and just modeling all that out, not just this particular ETF, but any of these leveraged ETFs where you start getting into options-based strategies, it really does get complex. And
Oh,
you
absolutely.
may have some surprises, not that the ETF isn't doing what it's supposed to do, but just you may have some surprises depending upon what happens in the market and then what type of returns you get. And so I just think this has made it's just much more complex for investors and advisors out there to wade through this stuff.
It's fine. They can, and this is going to be a callback. Just follow Warren Buffett and just say, just going to do index funds and short-term duration bond ETFs, and you'll be
Stay
fine.
away from the rat poison or rat poison squared, I think is what Charlie Munger called
I think
Bitcoin.
Buffett would hate this.
Oh, for sure.
I
Yeah.
think Buffett would
He wouldn't
absolutely.
touch us with a 10-foot pole.
No, absolutely
Yeah.
not. Again, that's not a knock on MST, but I don't think Buffett would appreciate this, but it would put this in his portfolio at all. So we'll talk Litecoin perhaps next week. ETF, Litecoin ETF was delayed. The decision on that is from Canary. The decision was delayed on that. So I know you're chomping at the bit to talk about Litecoin. We'll have to wait till perhaps next week's episode. We'll see when we finally get a decision through. But that'll be it for this week's episode of ETF Pulse. Nate and I will be back next week with more predictions on what's happening in the ETF space.